really understand what is the due diligence process here, to understand what are the questions that they should be asking the GP. What are the assumptions that you're making here? What is the business plan, really?
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if you're enjoying this show, leave us a rating and review. We want to hear from you. I want to hear what you love about the show, but also any feedback that's honest that can help us work harder for your investing goals, right? Tell us the kind of topics you want to hear about, the kind of guests you want to learn from, so we can make that happen for you and your investing dreams. Listen, if you haven't done so already, make sure you hit that subscribe button so you don't miss an episode. Now, today we've got a great show. We're going to be talking to Brad Shepard. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Brad Shepard is the licensed broker-dealer representative who helps retail investors take advantage of the upside of real estate ownership without the management headaches, partnering with experienced operators in the best markets to offer pre-vetted, hassle-free investment opportunities. Now, Brad has been involved in commercial real estate for over 20 years, and along with his own rental portfolio and a handful of flips, his experience includes development and management of retail and hospitality space and raising capital for both domestic and international investors. Let's welcome to the show, Brad Shepard.
Hey, thanks a lot, John. I'm excited to be here.
Absolutely. Brad, great to talk to you today. I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
All right, sounds good. Yeah, so I've been interested in the real estate scene since my high school days. I don't know what at first opened my eyes to it, but when I learned of it, I knew that was the path for me. So that's actually what I went into college for, was to get a finance degree. I did my internship with a large commercial real estate firm up in Seattle. My plan was, originally I wanted to go the MBA route down at Thunderbird University, where they have an international commercial real estate program. That was my plan. And then I actually married a woman whose father had done exactly that. He was in commercial real estate, having gone to Thunderbird. But after that internship and my graduating from college, I went down a different path. But that's where I got the opportunities to start doing some more accessible deals, where we were doing some vacation rental type stuff before Airbnb was a thing. We were buying some cool cabins in like Park City and Sundance area that we'd rent out for family reunion type of things, or the people coming in for a ski vacation weekend. And then we had some opportunity to buy some properties in Illinois, where it was a really cool development opportunity. So we actually built a hotel, a cafe, an art gallery there, and had to raise money from investors to make that one happen. When my wife and I, we moved to Texas in 2011. That's where I started building up a little bit more of my own rental portfolio, got into doing some fix and flips. Learned that wasn't really where I wanted to spend my time. I liked them, kind of some bigger deals, getting back into commercial. And so that's where I started going down the path of originally thinking I wanted to set up my own operator group and be a GP. I started investing as a passive investor with a couple of teams down there, just to learn how they function and operate. My first investment, probably one of the worst ones I've done to date, learned a lot of what not to do's. The next one went a lot better. Did a couple more with that group, and was really kind of about to start going down the path of setting up my own operation at that point. And that group came and said, well, why don't you work with us rather than go out and then compete with us to find these deals? How about you help us raise capital for the stuff that we're working on? And so that opened my eyes to some possibilities there. And 6 years later, after I set up, it's 6 years since then, I've been operating Sugar House Investments, which we've set it up as a private equity firm. I've gone out and gotten a couple securities licenses, so I can do this really on the up and up with a lot of transparency to our investors. And at this point, we partner with about 10 different operators that we help raise capital for their deals across a few various asset classes. And then, yeah, personally, spent 10 years in Texas. And then a couple of years ago, we moved up here to Idaho. So I'm in Boise these days. So that's my story in a quick nutshell.
I love it, man. Thanks for filling us in on that. So expected to go to college and get into this space, and things kind of transitioned a little bit. You decided, hey, let's start getting into real estate. You were moved down to Texas, started investing in some deals. Uh, you know, sounds like you had a couple great projects. Mentioned that one in Illinois, and then the one out there in Park City as well. But ultimately, you started investing passively as you were looking to go and be a GP yourself, found an opportunity to partner with another group, and ultimately went ahead and got your securities license to raise capital for these deals. Now, for those folks who may not be familiar, when you talk about getting your securities license, what exactly does that mean, and what does that afford you the ability to do?
So when an operator raises funds to go out there and purchase a whatever it be, an apartment complex, a self storage property, they want to start a restaurant, they want to whatever, they want to set up a yogurt franchise. When they're doing that type of a syndicated raise, a group investment, that is creating a security. And when you create a security, that means you're now in the domain of the Securities and Exchange Commission, right? And so they have all their rules and regulations that come with that, and how you can position that deal to potential investors, how you can compensate people who are involved in that deal. And so to stay compliant, there are really pretty much three ways that if you want to, as far as if you're not part of the GP firm itself, but you want to help that GP firm raise their capital, you can go out and get securities licensed and working with as a broker dealer representative. You can do a fund of funds model, or you can become a co-GP where you become part of that GP. You get tied in a little bit more formally into that GP structure. For me, I liked the flexibility and the transparency that the securities broker dealer rep route provides. So I had to do get a couple securities licenses, pass those exams, do the fingerprinting and the FBI background check and all that stuff. Have a broker dealer platform where I can hang my license. They have to sign that compliance team on my broker dealer side. They do their own level of due diligence. They have to sign off on everything that we work on, the marketing that we do, any materials that we put out there, just to stay compliant. And that allows me to be compensated in a really clean way from the GP, where my compensation is simply a placement fee or a percentage of dollars raised, and to be paid in that kind of format. The only way you can do that is as a licensed securities representative outside of the fund of funds or co-GP model. And so it comes with some compliance headaches. I'll admit that there are some pains to it, but it makes my relationship with the investors and the GP really clean.
No, thanks for sharing that. You talked about there really being three ways to raise money for a deal, right? So you can either be a broker dealer, which is what you have. You can do a fund to fund model, which is becoming more and more popular, or you can be a co-GP, which has its pros and its cons that come with it. You talked about for you, you felt like this is the model you wanted to go because it gave you some advantages. Can you just talk about the pros and cons of getting the broker dealer status as opposed to one of the other two options you mentioned?
Sure. The pros and cons. With the broker dealer, it can be cumbersome. Like everything I want to do, it doesn't matter if it's a tweet or if I'm going to go partner up with a GP and raise capital for them. I have to go get their approval, and so it can slow me down quite a bit. The effort there is that we're trying to obey those securities laws, and so that's the upside, is that it keeps me compliant, and it brings some level of trust to the investors that I get in front of. It's expensive. I have to pay a specific fee to my broker dealer every month. I have to renew my licenses every year, and I have to be licensed in every state wherever the investor is or potential investor that I'm talking to. So that nationwide, that's pretty expensive. And so that's the downside. The upside is kind of I was speaking to that the cleanness, the clarity of my relationship with the GP and the potential investor. I like the fact that I can tell the investor my fiduciary responsibility is to them. I sit on the same side of the table as them. So I'm not representing the GP. I partnered with them and I have the privilege of raising capital for them. But my job is to understand where that investor is coming from, their risk tolerance, their time horizon, what are they really trying to accomplish, and then I can show them 3 or 4 deals that might make sense for them and show them the pros and cons and the due diligence that we've done, and disclose to them how I get compensated, et cetera, et cetera. So I like that trusting and relationship. The fund to fund models simplifies a lot of those conversations, where now the fund operator is going out there and raising the funds, and going to go place that with some specific operators. And that fund, it depends on how the operator wants to set it up, whether it's going to be semi-blind, blind, or they already have some targets in mind of where they're going to go place that money. And so that can present some pros and cons as well. The investors, if semi-blind, meaning you're going to set up the thesis as we're only going to invest in multifamily in Georgia. All right. But you don't have those properties identified yet. But your investors know that's the thesis that has to be met before their funds are going to get deployed. And so you have to define that up front. And that can be, that can be helpful, or that can hamstring you a little bit. But if you find another opportunity in North Carolina, that fund can't invest in that. And so how blind can you make the fund and still have the investors feel comfortable? And then that fund is also going to have its own set of fees, because that fund has to go get set up by a securities attorney, and it's going to have its own layer of fees. And so you've got GP fees on the operator side, and the fund fees. And so that may hamper or harm the returns that are being sent to the investors. The fund manager may be able to negotiate a different return with the GP to offset that, but that has to be taken into account. It can become, it has some higher upfront costs to get set up, and have to make sure you're really going into it feeling pretty confident that you can raise the amount of money to make it worthwhile, before you start going down that route. So it's the broker dealer route gives you some, a little bit more, like it's less upfront. It does require those exams to get going, but I'm not incurring any costs outside of those as I'm talking to a potential investor until I've got some opportunities to talk to them about. So
Yeah.
that's a high level stuff, but those are initial thoughts that come to mind.
Yeah, I mean, it's definitely good to understand at least what the options are. If you're out there looking to raise capital and maybe partner with other operators, it's important for you to at least understand the structure of which you're going to do that, and not just randomly start talking to people, right? You've got to figure
Right.
out, how are you going to do this? Are you doing a fund to fund models? Are you getting your broker dealer's license? Are you going to be in a co-GP type situation? And understand again the pros, the cons, the risk, the exposure that come with that. So really important for people to understand, and certainly we can do do your own due diligence, do your own research, learn more about the space. But for you, the broker dealer route was the right approach to take. Can you talk to me about, how you work with investors, what that process looks like, particularly when they're exploring an opportunity, and how you kind of, I don't want to say coach, but how you help them navigate the investment landscape?
Yeah. So it really is a consultative relationship. I'm not a financial planner, but it's not unlike, it's that same type of a mindset. I'm not taking into account their entire portfolio and helping them figure out their allocations. I'm going to ask about that. How much exposure do they have to real estate versus some other, traditional equities or whatnot. But it forces me to have their best interests in mind and sit in a coaching, counseling, consultative type of seat with them, and helping them understand, what's the difference between Class A and Class B, or this multifamily apartment complex in Dallas versus this industrial fund. One is more, potentially more lucrative. The other one is a little bit more conservative, but a really steady cash flow scenario. Do you want to wait for the equity, or do you need the monthly, very predictable monthly cash flow that's going to be based on their goals, their age, their risk tolerance, et cetera. And so for me, process is, as I'm working with or interacting and meeting with these individuals who have expressed interest in investing in real estate passively. It's getting to know them and their situation, talking about the deals that we have available, or the ones that we've worked with in the past, if we expect something similar to come up again in the future. And we're pretty low key about it. We send out, we find somebody who's interested, and I just kind of add them to our email database. They get that the monthly emails that shows all the projects we're working on, or when we launch a new deal, we send out an email for that. And if they're interested, we just ask them, hey, if you're interested, let me know. And then we jump on a call to talk through the deal specifics and make sure it makes sense for them and move forward at that point. And I'm getting compensated for introducing them to the GP. They're going to have the same experience as if they invested directly with the GP, as far as same returns. They're going to have an account within that GP's investor portal, but we also have our own investor portal, so they can log on to our portal and see all of the deals that they've invested with with us, across the various asset classes and their consolidated returns, et cetera. And then, our effort is to be a little bit, provide a really accessible concierge type experience for them. So the returns are the same, but we hope to deliver a little bit more of a concierge feel and accessibility level to the investors.
No, I appreciate that. Can you talk about, the deal criteria that you look at? I know you mentioned, as an example, maybe an apartment building in this state versus maybe an industrial building here. What kind of deals are you looking at?
Yeah, so it does vary by the asset class, but the majority of the deals we work on are in multifamily, and our parameters in there are pretty typical B class, 1990s, maybe late 1980s build. We're not going into war zones or looking for deep turnaround projects. I mentioned the first deal I invested in as a passive investor. It was exactly that: war zone, deep turnaround project. Everything that could have gone wrong did, from the permitting, the zoning, Hurricane Harvey coming through and knocking down some of the buildings. So we've stayed away from those kind of deals. We like the ones that they're already performing, right? So they're already generating cash flow. We can tell our investors, yeah, month one after closing this, there's going to be distributions happening because it's already producing. We're just going to go in there and optimize it, bring it up to 2023 standards, put in the Amazon lockers, the nicer gym, the facades, et cetera. So it's optimizing rather than deep value add or deep turnaround. And in high growth, high population growth areas. Same thing on the self-storage side. We need them to be in high population growth metros, so that there's going to be consistent demand for those storage units. On the industrial side, the partner we're working with there, we're doing a sale leaseback strategy where we're purchasing buildings from a business that's been in there for some period of time, large operations, companies that are doing at least $100 million a year. They want to sell one or two or more of their buildings for a cash flow infusion, but they're going to stay put. So they become the tenant. They sell us the building, become our tenant. 20-year triple net lease with agreed upon rent bumps within the lease terms. And so for that one, the geography doesn't really matter. That's taking us into middle of nowhere Kansas, middle of nowhere Utah. It doesn't really matter. It's a facility that they've put a lot of money into. It's a financially sound company. They're going to stay put, and we're just become the essentially the landlord for that operation. So that's been a fun asset class for us to be offering to our to our investors, just a little more conservative cash flow play, and in some new geographies. So those right now are the three asset classes that we focus on. We've been kind of dipping our toe into a relationship with an operator that does some new development. That would be, and we're doing that simply because our investors have been asking for something along those lines. So we've been exploring that. Mobile home parks is something we worked on in the past. Well, I think we'll do that again in the future. But yeah, that's again one of the advantages we try to bring to our investors, is that we've got multiple asset classes, multiple strategies and classes for them to consider.
Yeah, and I think too, you talked about multifamily, late 1980s, mostly 1990s and newer, industrial, kind of more geographically flexible because you have this lease back strategy, and then self-storage, similar demographics that you use for multifamily. I think the thing that I heard you say was you're looking to, mitigate risk as much as you can based on the actual asset and the business plan that you're taking on. Looking
Right.
for things that are cash flowing, or you have a clear way to make money out of the gate, and then your plan is to figure out how do you grow that over time. And I think that's a great way to think about it because, especially if you're a newer investor or you want to be an LP, yes, you could swing for the fences on that great deal that's going to be a gut rehab project. But typically those deals don't produce cash flow out of the gate. You're going to need time to turn things around, and the market can
Right.
shift and it can change. And, you may not have as much flexibility if you really needed to, again, gut rehab these units and rent them out for $2,000, whatever it is, versus if you have something that's stabilized, you may have more flexibility to slow down renovations or to do this or do that. So I think it's really good for people to understand and to think about. We talked about the kind of investor LP side. First of all, if someone were interested in learning more, what advice or resources would you share with them to learn more about maybe being an LP and working through someone like yourself?
I would the market has shown, especially in the last just 6 months, I've kind of used the phrase a little bit that right now is the time to be an active passive investor. You really need to understand the group that you're investing with and the deal that you're into. We see just too frequently investors who didn't really understand the project well enough, the team's experience. They invested in a project because a friend recommended it. You really like it would behoove the potential investor to check out some books, to listen to a couple, many podcasts. You really understand what is the due diligence process here, to understand what are the questions that they should be asking the GP. What are the assumptions that you're making here? What is the business plan really? What have your past, how have your past projects gone compared to pro formas? What are the expectations here that as far as communication and distributions? Diving in deep, who on your team really understands the loan covenants? So when interest rates jump and we're now in a situation where we're going up against a debt service coverage ratio scenario, and what does that mean? Because could the loan be called? Are they gonna? Is that what's gonna? What are the implications there? Somebody on that team really has to understand the financing intimately. And so it's a really important for the LPs to understand those questions that they need to ask. That's the type of service we try to provide. I know people can go off and do it on their own, but I just say get yourself really educated, so that you can be a very an active passive investor. Once you're in, that team's doing the job, and hopefully they're communicating well, and everything goes smoothly. That's the whole point, right? Is so that people, the passive investor can go focus on other things. But I think the work comes before you sign those documents and before you send in the funds.
Yeah, Brad, that's a great way to put it, right? The work comes up front. If you want to be passive, that doesn't mean you just throw your money to anybody you ever, see or hear talk about, real estate investing. It means you do your work up front, right? You vet these individuals, you ask the right
Right.
questions, you understand their track record, and then and only then do you go ahead and make that investment. And then once you're invested, you can step back, right? Most groups are going to communicate with you, but that's something you certainly want to understand prior to making that investment. But you'll get a chance to read those updates or to understand what's going on and ask questions if you have questions, but you're not going to be the one responsible for the performance of that investment. And I think that's what
Right.
many people are looking for if they decide they want to be passive. On the flip side of that equation, right? There are people who are listening to you talk, Brad, and they're like, "Man, you know what? I could use someone like Brad to help me raise money for these deals that I have." What does that process look like when you're in?
Yeah, it's there are lots of folks out there like me out there, and the I think we try to provide a really valuable service to the GPs. For the GPs that we partner with, we're not their exclusive capital source for the equity portion. They're out there raising funds through their own channels as well. The funds that we bring to the table, right? They have to compensate us for that, and so they're motivated to bring in their own dollars, and but they're going to give us a specific allocation, a portion of the funds that they need to bring into the table. And so it can be it can be really deal specific or operator specific, how much you want or need on a deal by deal basis. The compensation is pretty industry standard as far as how we're the broker dealers are paid. But it can be really helpful for plugging those gaps or providing some confidence if as a team is ramping up and they want to go out there and secure more deals, but have a little bit of hesitation about being able to raise that capital to secure that, the deals that they're seeing and getting excited about. a relationship with a firm like mine my peers can be a good tool to have in your back pocket when you're looking at doing multiple deals at the same time, where you might feel a little bit nervous about the dollar amounts that you need to get into the bank account to take those deals down.
So if someone's listening and they say, "Yep, I want to work with someone like you," what does that first step need to look like, or what does that vetting process need to look like?
Yeah, it is a process, and it is a bit onerous on the GP side, because we have to get to know you really well, and my broker dealer has to get to know you really well. So we're flying out. My team. We're going to be spending a number of days together, touring your properties, breaking bread together, getting to know you, showing the family pictures, getting to know this team really, really well. And then we're going to be poking into the financials, right? We're going to dig deep into there to see how things are going, with the current projects, with the prospective projects. Um, we had to do background checks on the team, and so it is onerous. And then when there is a deal offering memorandum ready to come out, there's the GP is going to have their version. I get it. I kick it over to my compliance team, and they go over it with a fine tooth comb. And I go back to the operator and say, all right, I need to change this. I need to change that. We can't say that. And so we had to go do that back and forth with the GP team as well. So there are some hassles. There's no doubt about it. There are some hassles in working with a broker dealer because of those compliance needs. The vast majority of the work is up front. Once we've gone through that process, we understand this is a team that's experienced and they're successful. We feel like we can work together. That's 90% of the work there. And then it's going to be, some deal level due diligence going forward. And so it is a big upfront effort, but all of that having been done, makes it so that when we do have a deal, our investors know we've gone to a great lengths to do that due diligence at the operator level, then at the deal level. And so they can feel comfortable in moving forward with us. And then again, when we launch a new operator to our investors, we see, so there's some, the early adopters. And then as we continue to do deals together, we were able to bring in more and more funds to that investor, or to that operator group, as our investors get more and more comfortable and confident and familiar with that team. And so we can expand that relationship as we and our allocations amounts as we continue the relationship as well. So once we're up and running, it's a really great working relationship, but there are quite a bit of hoops to jump through at the beginning.
Well, I think it's good for people to understand is what you said, right? Part of the reason you went through this process was this is going to allow it to be a bit more, I don't want to say professional, but definitely more regimented, right? It's looked at, you've got to go through and make sure everything is compliant. And because of that, there are going to be more checks and balances throughout that process. It does make it more laborious or, intentional where you're going through a bunch of different checkpoints. But on the same note, deals that, make it through, there's a pretty good feeling that, hey, these deals have been vetted by a number of people. The things that were put into this offer memorandum have been vetted through a number of people. So people can feel good knowing that. Doesn't mean it's a guaranteed return or anything like that. I don't want anybody to misread this. But what it does mean
Thank
is
you.
that a number of people have looked at this and at least blessed the opportunity. If folks do want to learn more about it, oh, go ahead, please.
And that's huge, right? I mean, we talked about like, it's a common theme is if you take a project to your bank and your bank won't loan on that, that's great, right? That they've done, they know what they're doing. They're looking for some red flags, and if they're seeing those red flags, that might save you from going forward on a bad deal. Another good level of your due diligence process. Same thing if you take your deal to a broker dealer firm and they don't feel like they can help you on that raise, we'll share the feedback as to why. That could be another solid level of your due diligence process, helping you either fine tune a couple things or avoid going forward with a deal that makes sense. That if we look at it and say, yeah, no, our investors are not going to go for that, not going to bite on that. Then the GP can take another look at it and say, all right, do we really want to move forward with this? And so we try to provide that level, that element of service as well to the GPs, and helping them understand, what investor appetite might be and what they could do to fine tune a project before they move forward.
No, I love that. And listen, if folks do want to learn more, whether on the LP side or the GP side, they can check out your website at sugarhouseinvestments.com. Right now, we're going to go to our round of insights. Are you ready?
Let's do it.
Give me a failure or an apparent failure that set you up for later success.
Yeah, I mentioned that first investment as a passive investor in Houston, 2 hours south of Houston. So we were out of the money, right along the coast, turnaround project, bad neighborhood. There were some new development efforts. The operator was new to the area, didn't know the zoning process well, didn't do the zoning correctly, didn't do the permitting process well. And then we got in the middle of all that, got slammed by a hurricane. That taught me a ton as far as what my due diligence checklist should be as a passive investor, to then help me figure out what that due diligence process should look like as a broker dealer representative in working with other operators and raising funds for them. So it's, I'm still waiting to get my money back out of that project, but I've made up for it and well beyond it through the lessons learned from that experience.
All right. Give me a digital or mobile resource you recommend for your business.
I've been trying to figure out where AI fits in my business. I've been using Otter AI recently, but the app and the website, just for transcribing thoughts as I'm out on the fly, speaking random, just brain dumping into that thing and then having it turn it into usable transcripts for me. That's been a new toy that I've been playing with. A little more time spent with Twitter. Honestly, Twitter's been a really fun place for me to hang out, connect with other operators, investors, just real estate professionals in the space. So I wouldn't discount that as a place to hang out and learn as well.
Give me the book you've recommended or gifted the most in the last year.
Oh, good grief. I'm blanking on it right now. Money mindset. My goodness, I've got it right over here behind my shelf. Oh, darn it, man, I'm totally blanking. So the premise of the book was just time and diversity being the biggest assets in individuals or investors' tool belt. The biggest wins coming from having a diverse portfolio and being patient. Money mindset. Oh my goodness, I'm gonna have to. It might come to me here in just a minute, but I just read it maybe, I don't know, 10 or 11 months ago, and I've shared that with up and comers, people who want to be a little bit more go gangbusters. I like the idea of like just slow down a little bit. Do you really need to swing for the fences, or could you be a little bit more patient and achieve the same results? And the name's going to come to me in just a minute, John. Sorry about that.
No worries. All good. It happens, right? All right. Give me a daily habit that helps you stay focused on your goals.
Yeah, I like to wake up early. I'm a morning guy, and it's had to get earlier and earlier as my, having kids, and then they have to wake up for school. So I go out and work out with a group of guys pretty early in the morning, most days each week. And then when I come home from that, I have maybe 20, 30 minutes before the kids start stirring. And so that time for me is the time to review my day, think about my goals. I have a mantra that I've used that I repeat to myself. Call it a meditation, call it a prayer, but it's a reminder of really who I am or who I desire to be. And that's been really helpful for me in just thinking about what it is that's really important at the end of the day. And that part of that mantra is my relationship with God, my relationship with my family, my relationship with my kids, my relationship with money, and keeping them in that priority. And so that's been really helpful for me to kind of just be in the right mindset as the day gets going.
Give me your number one insight for investing passively in commercial real estate.
Me. Yeah, working with a broker dealer representative who understands the ins and outs can be hugely helpful. But there are good books in this space that are targeted just for passive investors. I think the podcast scene as well, shows like yours, John, are so powerful for folks who like the idea of investing passively. But I would say for people who want to place funds passively, it's an important part you're talking about big checks, right? And going in and working with an operator who's going to tell you all the things you want to hear, but not having the experience to do a proper level of due diligence. Sitting down with your tax professional, a securities attorney, your CPA, a broker dealer representative, somebody, your financial planner, to help you understand those questions is really important before you move forward. I think too many LPs do it just kind of trusting their gut feeling. So I think just having some people over your shoulder, looking over your shoulder to help you understand the questions you should be asking is can be really helpful.
All right, and you have moved to Boise, so we're gonna finish with this one. Give me your favorite place to grab a bite to eat.
Um, my wife and I consider ourselves foodies, but having the kids these days, the place we go the most frequently is the burger shop. We go to a place called Boise Fry Company. It's as Idaho as you can get. Their burgers are okay, they're decent, but then they have like 20 different versions of potatoes that you can get for your French fries, and then tons of different sauces and seasonings that you can top it with. But yeah, you go in there, yeah, I'll take the purple, I'll take the russet, I'll take the gold, I'll take the sweet potato, whatever. 20 different potatoes. It's so Idaho. We end up going in there quite a bit.
I love it, man. Hey, listen, if anyone loves fries, sounds like that is the place to be.
Come to
Brad,
Idaho.
you gave us a lot of great information. I appreciate you sharing a little bit about kind of your backstory and what got you into the space, but also talking to us about being a broker dealer and the differences when it comes to raising capital and kind of the three pathways you can take, but also going into the pros and cons of working with a broker dealer and what that process looks like, and knowing that there are more steps involved, but part of that process is getting more eyeballs, and hopefully that allows more issues or things that are flagged to be caught early in the process. So that provides a little bit of a layer of protection for investors. For folks who want to learn more or check out what you are working on now, they can go to sugarhouseinvestments.com. Brad, I want to thank you again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.
Thank you very much, John.